Hey there, it's Mike Langford. Welcome to the Augmented Advisor Podcast, where we showcase thought leaders, ideas, and strategies to help improve the advisor and client experience in wealth management. The Augmented Advisor is brought to you by Blue Leaf, the all-in-one wealth management platform with best-in-class advisor and client experiences in reporting, billing, and rebalancing. On this episode of the show, John Prendergast and I invited a couple of our favorite guests to talk about a concept called banking as a service that is set to dramatically improve your ability to render comprehensive financial advice to your clients. And of course, we also talked a bit about what's going on in the banking world at the moment as well. Who are these guests, you may ask? John and I will tell you in just a second. But before we get rolling, please take a second to follow or subscribe to the show wherever you are watching or listening so you don't miss an episode. Okay, buckle up. Here we go. All right. Hey, John, it's Bring Your Favorite Banking Buddy to the show week here on the Augmented Advisor Podcast. I brought Scott Wetzel, CEO of SkyView Partners and SkyView One, which we're going to be talking a lot about today. So thanks, Scott, for joining us. It's wonderful to have you.
You're welcome. Appreciate getting to meet you all today as well.
And I brought a longtime friend, Jason Henrichs. Jason's the CEO of Alloy Labs, which is a consortium of banks. And most awesomely, he is the host of Breaking Banks, the largest fintech podcast on the planet. Welcome, Jason.
Yeah, I need new hobbies is what
Mike,
it comes
look at
down
your
to,
guest. I mean, you're struggling here. I mean, come on. Come on. Next time, bring in a ringer like John did. I mean, come on.
I mean, hey, listen, I had to bring somebody. I mean, like, but here's the deal. You've got the best hair, like, literally the best hair of all of us here.
Scott,
so,
I always want to win, man.
Right? That's a win in my favor.
It's a house of cards up there, my friend. It's house of cards.
Well, look, I just go with the aerodynamic look here.
So, Mike, this is a big week in banking. We got some stuff going on.
Yeah.
We probably ought to talk about it.
Why?
A couple of weeks from now, it'll cool off, but we got to talk about it.
We ought to talk about it.
I hope it'll cool off.
That's right. So, just a quick point of order here before we get started. We are recording this episode on March 14th, 2023. And we don't normally timestamp these episodes, but there's some banking news in the past few days that's bubbled up that we'd be remiss if we didn't talk about.
Oh, yes.
So what's up with Silicon Valley Bank, Mike?
So, Jason, I hear you're a big fan of hot takes, so I wonder if you wouldn't mind coming in off the top rope and starting us off.
All right. So I think you've been living under a rock if you did not know that Silicon Valley Bank was taken over by the FDIC. And so the good news for my business is we went from the 18th largest bank in the country to we're now the 17th. Actually, it's not good news. It's not good news at all because it went down for the wrong reasons. So let me give some of the backdrop about what people might not have followed, and there's some misinformation out there just because people who might have made billions of dollars and think they're the smartest people in the room with the bigger podcasts than Breaking Banks doesn't mean they always have gotten it right. So if we think about, why does the banking world exist? And a big part of this is it bridges the fact that you want a place to safely store money and you need another place to borrow money from. Now, when you talk about storing money, to get you to store it in large enough sums, I have to induce you to do that. And I pay you an interest rate normally. And I'm willing to pay you a bigger interest rate the longer you're going to store it with me. Why do I care about that? Because most of my loans are not short-term loans. This idea that I could walk into the bank and say, give me all my money. You don't do the same thing. It's like, hey, I'd like to sign up for a mortgage. And I say, great, Mike, how long of a mortgage do you want? You're like, I'd like a 30-day mortgage, please. Right? So there's this mismatch between timing. And what ends up happening, the bank, and I teach at 3 of the graduate schools of banking, the number one course, you spend your entire first year learning about asset liability management, or ALM. How do you actually make sure for the long term you're generating yield, but you have sufficient liquidity? Now, all that has been turned into the upside down land for the last 15 years because the federal funds rate, the rate at which you can borrow money from the government, has been basically zero. So a lot of banks, just going to call it out, get a little spicy, have gotten lazy, fundamentally lazy and greedy in their approach to ALM. and this is what brought Silicon Valley Bank down, is because they could borrow from the government at virtually no cost anytime they needed it. They locked up a whole bunch of money, like at an average rate of 3 to 5 years, to eke out a 1.8% guaranteed return in a held to maturity security. Except then they got caught with their pants down. Can I say that on your podcast? I would probably be more explicit on ours. They caught with their pants down because they're like, oh my goodness, we never could have expected interest rates were going to go up. How dare they raise interest rates to fight? And they did it rapidly. In fact, it's almost up to where interest rates were before. They turned themselves upside down. They needed liquidity. They fumbled it, which we can get into, because this is not just a bad job of ALM. This is about communication and managing customer expectations. And that is what brought Silicon Valley down, is they need better communications.
I love it.
That is a hot take, man.
That is a hot take.
There's smoke coming out his ears right now, guys.
Yeah. And listen, to make sure we loop Scott into this in a really relevant way, we're going to be diving into Scott's business, SkyView 1, and some of the things that it means for members of our audience, namely RIAs and executives at wealth management firms. But, a lot of news has been made, I guess, in the mass media, right, about it, because Silicon Bank was so concentrated in one segment, right? That they served a niche, right? Namely the tech industry. So anybody who works for a tech industry, chances are they're doing business with Silicon Valley Bank. And one of the things that I read that was really interesting this morning, actually kind of digesting what's been happening, was many of these companies are venture backed, right? So they get a lot of money put in with the explicit intention of spend that money quickly, invest that money. So that money is constantly drawing down. And this is it. Maybe one of you can talk about this, Scott. I'll tee you up first. They also have something called a brokerage relationship. So a lot of the funds, like a venture fund, may have 100 of its portfolio companies at Silicon Valley Bank. And when the venture fund says, "Hey, maybe you should pull your money out," it doesn't just take one account, right? So. Right. What are your thoughts, Scott? I mean, we're in a completely different industry, but as you look at it, how do you see what's happening there?
Where I'm most concerned with this is it's something like 57% of U.S. deposits are in the top 5 banks. Hard to believe, right? Concentrated right there. And Jason can probably speak better to this, but their deposit loan ratio is not what you find at the regional and community banks. Are actually out there doing what they're supposed to be doing and keeping the economy, thriving by actually extending credit to businesses and people who deserve it. Instead, the big banks are making a ton of money off of people, overdrafting, check stop, whatever it might be. And really, as I see this, I don't know what Silicon Valley Bank did wrong. It's obviously balance sheet mismanagement, which really shocks me because, from our vantage point, we're always trying to get more banks to partner with us to invest in advisor M&A financing. And I will tell you, to get through the credit departments of these different banks to try to get them to approve this, just because it creates too much balance sheet risk. I know it's top of mind for all these banks. We had not had a discussion with Silicon Valley Bank, but I can tell you that one of the banks that has recently failed or been closed actually rejected our advisor loan portfolio as being too risky. Which I find rather serendipitous today, because whatever they were doing didn't work out very well, and we've had 0 defaults, 0 charge-offs, and financial advisors are very well-behaved borrowers. We've had 0 late payments since inception on close to $1 billion in funding. So it's turned out to be a very good asset for our banks. Not all banks feel that way, but somehow they mismanage this in a very, very critical way. But the larger concern for me is getting back to the impact it could have on the lifeblood of this country, in my opinion. And I'm not a paid spokesperson for regional and community banks, but it's the truth. They're the ones out really doing the loans that really matter to keep businesses thriving. And you take them out of the equation, we have a run on the banks at just a few community regional banks. We got some serious problems all the way around. So I think by backstopping this, what the Fed did, had they not, we'd had real problems. I actually saw lines outside of First Republic on Monday morning in Los Angeles. I've always said that when we get to the day that you see lines outside of banks again, we got real stress. So we had real stress there for a short period.
It's nuts.
So I'm curious. This kind of reminds me of a storyline from a famous movie that gets played around Christmas time. Uh, Jason, you know what I'm talking about. It's a Wonderful Life, and the uncle misplaces the money, and then the buddy Sam Reed, the FDIC, comes in and backstops the bank, and woo, everything's great. But long term, sort of, where does this go? Like, what implications does this have long term for banking in general? And I think specifically around community and smaller banks. Is there any implication here?
Well, I would actually broaden that to say it has the same implications for advisors as it does for community and mid-sized banks, because as Scott had set up, you have this systemically important banks, right? The top of the money markets that are, quote unquote, too big to fail, but also, by the way, have enough money that the likelihood they fail, especially now that they're being much more conservative post 2008, and they have to do stress testing under Basel and Basel 1 and 2. If you look at the advisors, you have something similar when you look at the big wirehouses in terms of their ability and propensity to go do new things, right? They get slapped with $1 million fine here, $1 million fine there, no big deal. So they can keep innovating and pushing the boundaries of what client experience is going to look like, the types of products they offer. For those that are focused more on safety and soundness and probably more on the one-to-one personal relationship and serve probably a different segment of the market, they're in danger of being left behind. And I think the part that accentuates this, regardless of which regulator we're talking about, we tend to be reactive in nature to when regulation catches up. And I would say this is much a failure of regulation where bank runs, when it was lines outside of banks, it's pretty obvious to say, hey, shut the doors and we're going to take a bank holiday and get back to you. When you're talking about, from one of the venture capital Slack channels I'm in, it takes one VC sharing that one of their startups that had just raised a Series D wired $240 million out, right? And then the next one, when you're talking about $2 billion flowing out in less than an hour, that's a problem. Like, regulation and our controls were not set up to deal with the impact of social media, people who think they understand ALM and economics who really don't, but have massive followings pushing out a huge agenda.
Well, I heard that how many regulators are going in to investigate this, Jason? I've heard a bunch of different groups, but we need like one of those cop shows, like Internal Affairs Special Investigative Unit, like. Who's checking the regulators, to your point? Like, is there really oversight committee saying, like, okay, who really screwed up here? Because there's a lot of people involved, right, that got this wrong. Certainly not picking on any examiners from any part of the country, from any regulatory body in banking, don't want to do that. But there were some mistakes you made all the way around, right? And from a regulatory standpoint, and from obviously from Silicon Valley, but then we found it's a little bit more systemic than this. We had Signature, $3 billion great bank in New York. It's gone. It had nothing to do with crypto. Are there others? First Republic started, to show some stress. But I think what we learned that they redefined too big to fail on Sunday, that you don't have to be a big four, big five anymore. They learned that too big to fail is if this, what's not considered historically too big to fail, if we save this one first and don't spend that much money, it probably won't get to one of those larger ones and get more systemic. So I think, long term, the repercussions, who knows? But at least in the short term, we fight another day.
It sounds like you're saying, though, Scott, that they've gotten a little more savvy about which bank to rescue. And that sounds like maybe a net positive.
It sounds like they've wised up the fact that if they don't do something more rapidly and, letting Bear Stearns, letting Lehman fail, when they're going to start bailing out anyways, had they just saved Bear Stearns, Lehman, maybe that would have been the extent of the damage. We don't know, right?
Yeah, it's interesting. You read a lot of articles talking about, let SVB fail and so forth. And it's like that missed some of the potential repercussions. Like, hey, guess what? A lot of payroll was due to be paid this week. And suddenly you have.
Well, and keep in mind, they did fail their equity holders. That wealth is gone. A lot of people are talking about the people that worked at SVB. that had nothing to do with this and are doing a great job there. Lost their jobs and probably lost a lot in terms of company stock. One interesting thing I read, though, they do own a portfolio of something like 25 million or 2.5 million, I can't remember the number, don't quote me on it, of warrants and stock options in a bunch of fintech companies. So that's what we're supplementing to somebody someday.
Somebody will come in and buy that.
Tough to liquidate now, though.
Exactly. So it's interesting. I think what a knee-jerk instinct is to think this is concentration risk, right? So don't be concentrated and serve a specific niche. So people would hear that, SkyView Partners and now SkyView One, which we're going to be talking about in a little bit more in depth. That's a concentration risk. You're serving the wealth management space. But not all niches are created equal, right? There's higher risk. Yeah,
we're far superior, yeah.
But like as an example, like most startups, most venture-backed startups are operating at a big loss, right? They have no intention on being profitable in the early years. It's all about grow fast, scale up quickly. We will be profitable later. And some of them, it's like, we don't even care if we're profitable as long as somebody comes and acquires us and we take our investment off the table. That's not the business model that most of our audience is dealing with, right? Most of our, whether it's an individual solo RIA or it's a multi-advisor shop, they're operating for profit and with really aggressive and strong cash flows, right?
Yeah, I think there's obviously very different business models between the two. And it has been a struggle, I can tell you, since firm inception. The biggest question we had going into this business, would banks fund the succession and movement of a practice from one advisor to the next? And banks love tangible assets at the end of the day. And we got a lot of no's. We got thrown out of a lot of boardrooms. When we used to walk out, my partner and I'd say the same thing: no tractors, no silos. As soon as we can get advisors to start buying tractors and silos, we got something. But as they've learned more about our industry, because banks have historically funded legal practice transition, dental, and we used to hear this all the time. They say, well, people are always going to get cavities, but what if the stock market goes down? I really love that one now, because after COVID, I got a cavity. People still got cavities, but you couldn't go in and get it fixed. But everybody's on the phone getting financial advice from their advisor. In the financial advisory community, actually, we saw an uptick in revenue by the end of the second quarter of 2020. It was one of the best performing portfolios in the nation in terms of performance during the pandemic.
It's crazy. It's amazing.
Yeah, I think that goes more generally to all recurring revenue businesses without, tangible assets, right? Software as a service companies, same thing, right? Tough to get lending in the last decade. And it's only really in the last few years where you're able to fund really solid recurring revenue model of any kind. And that's great. And just more on the whole business model of the businesses Silicon Valley banked, other than the wineries, bear in mind that most venture-backed businesses go out of business. Most of them fail. And not by a small margin, because it's a hits business. You make your portfolio on 1 or 2% of the investments you make, or 10% rather. So it's wildly different. And recurring revenue, I think most banks are coming to realize, are much safer investments than anything like this. And I guess it's careful what you concentrate in.
Think about it this way: if the financial advisor is doing his or her job to diversify that pool of assets and that portfolio for his or her clients, therefore they may not be cognizant of it. They're actually diversifying their own revenue stream. So when we talk to banks, he's like, well, you've got exposure to basically every U.S. equity sector, every U.S. bond sector, sometimes international sectors. This is actually the most diversified recurring revenue stream you can imagine, because it touches almost every single equity in this country in some form or some packaged product, if the financial advisor is utilizing modern portfolio theory and diversification, which we have a CFA on staff that makes sure they are. So it's actually an exceptionally diversified revenue stream that's not just easily quantifiable. If the market goes up, it goes down. Well, we all know not necessarily.
Wait, markets just don't go up into the right forever?
Oftentimes not as much.
Wait, like interest rates might go up? Interest rates could
We
They're
know
not
that
like
one.
Justin Timberlake up and to the right. Like life just keeps getting better. It's like, no.
Well, I want to push on this concentration for a second and bring us to something that I think is particularly germane to this audience. Most bank failures are because the banks either concentrate in a certain sector, call it housing, and that sector goes down, or turns out they're really bad at underwriting. They've got a bunch of really bad loans, right? This is what happened, with Bear Stearns and Lehman turns out they suck at their job. And it turns out in this case, the person who sucked at their job within Silicon Valley Bank is the person who manages investments, right? And just didn't understand that for, the greed of going after 400 extra basis points, they didn't actually hedge that interest rates could go up, right? And the concentration risk, it wasn't that the underlying tech startups went under. That was not their problem. They actually don't do as much lending to tech startups as you'd think. They actually do more lending to wineries than they do to tech startups. Where they failed, right, because they had enough tier one capital, this should not have taken them down, is they botched the communication plan, right? There were 3 strategic things they needed to do. Is they wanted to increase liquidity, which that meant that when you sell a held to maturity security, you actually have to mark to market. Before that, if you're intending to hold it to maturity, you hold it at 100%. They had to take the write down, right? Tune of $2 billion when they were doing that, because they wanted to increase liquidity, recognizing that, with interest rates growing up, their bond value was going down. They wanted to take the medicine earlier and fix the balance sheet. That was actually good. They were being proactive to get themselves out of the mess that they had made. Here's where they screwed it up, though. They needed to go raise money, right? And they had conversations going with some of the largest providers. And then they decided to just put it out there as a press release. No story, no narrative, no timely communication. As a customer in our portfolio companies, our customers at Silicon Valley Bank, I've worked with them for 22 years. I find their investor deck on Twitter, right, on Monday, and I start to panic going, where's the message around this? And the timeliness around this? They just dropped it after they had done their quarterly filings. And they, for a tech industry focused bank, do they understand how email works? Do they understand how webinars work? The ability to pull in key segments to communicate financially, their fundamentals are still strong. There's no need to make a rush on the bank. The silence that was then filled by the Twitter talking heads, the bobbleheads, overtook their narrative because they were afraid to push a communication out.
They're the opposite of GameStop.
Exactly. Opposite of GameStop.
They just did a horrible job of, one person, who's in charge of their PR and investor relations? I'm not going to name any names, but I think it's a very salient, excellent point that no one's really talking about right now. That fumble was enormous, and who knows if they would have got anywhere near this. It created the fear that became just contagious.
Well, and I think that takes us back to when we talk about the traditional advisor and client relationship is our customers are used to getting instantaneous information and feedback from the internet in a real world as it's happening moment. And as advisors, I know we're very hesitant, and we have regulators that look over our shoulder related to this that make sure we're giving good advice. But the desire to get to perfect advice rather than giving any commentary and being proactive in our outreach, that vacuum allows the Twitter sphere, the Facebook sphere, cable news to take over the narrative.
CNBC.
Yeah, right. It takes over the narrative in our clients' lives. And it's super stressful. By the way, once they have that narrative in their head, like that the markets are crumbling or that there's going to be a run on their bank, changing the narrative is much harder than if you had planted the seeds to solidify their position on where reality is.
Yeah, proactive communication solves this in every industry. So,
Love it.
Given all this, I want to pivot just a little bit and think, okay, if I'm an advisor and I think about Silicon Valley Bank and this implosion and how challenging banking has become, why do I want to get into banking? So, Scott, why should an advisor want to deliver banking? Now, we know the wirehouses have done it and quite successfully. So can you talk a little bit about what this brings to the table for an advisory practice to introduce banking to their clients?
I think when you say that the wirehouses haven't done it successfully, I think in terms of their P&L, I'd say that they would disagree with that statement. And if you look at the actual penetration rates amongst wirehouse advisors, over 50% of wirehouse advisors have actually embraced banking products and services for their clients. And I recall, and I've been in the industry too long, and when they kind of rolled out the partnerships with the banks, UBS, Morgan Stanley early on, I mean, the advisors, anything that comes from the home office and doing it is different. Like, forget about this. We're not doing this. They want us to push this. We're not going to do this. We don't even know what it is. But they're asking us to do it. Therefore, the answer is no. Then they started looking at it a little bit more and said, well, wait a second. I think that's the way we can make money here too. And that kind of got their attention finally. But then also they realized that it goes to something broader, that they can have better view into their client's total financial picture and offer, really be that primary service provider to more than just investment advice, but also to their banking products and services. There's only one problem with their model, as I see it. They're acting, at least in a suitability standard of care or a fiduciary, as to the investments, and offering a broad range of investments, all at benchmark costs and performance. When it goes to banking, they're offering one bank, here's the deposit rate, here's the rate that you get on your loan, take it or leave it. So when they switch those hats, it's a very different experience for the customer. And what we aim to resolve for is kind of extending that same standard of care that's incumbent upon the fiduciary registered investment advisor. Why can't we do the same thing in banking? Why can't we offer depositors the best possible rate on their deposits, and then help them find the lowest possible rate on their loans? Because we're not carrying a balance sheet, so we're not concerned about net interest margin is the whole banking. That's all it's about, right? Well, in our world, we're trying to pay them the most on the loans of the banks, or I'm sorry, the liabilities to the banks and deposits, and then charge them the least on the bank's asset or on the loans taken out by the consumer. And that's flipping banking upside down and doesn't fit within a fiduciary context. But when you don't hold the balance sheet, it does. And that's where we think that financial advisors are actually in an excellent place to be that quarterback for banking products and services, to the extent that we can provide them a platform to extend that fiduciary service, not only to mortgages, but to cash management. Do you really, especially in this environment, do you want to keep all your assets at one bank? We have a sweep program. We'll sweep to 4 different banks. You can get up to $1 million FDIC insured. And everyone talks about, well, is this bank safe? Is that bank safe? After Silicon Valley Bank, I don't know. If you ask me about Citi, I think so. Apparently, they're not too big to not bail out either, obviously. But who knows who's next? And really what you have to fall back on is FDIC insurance. If you look at globally, is there a safer spot to be? I don't think gold is. So everyone should be attempting to maximize FDIC insurance as much as possible. But historically, banks, they give you your $250,000, that's all you get. You saw that 93% of deposits at SVB were uninsured. So that could have caused a massive problem, first of all. But with our program, we want to try to offer heightened FDIC insurance to every single depositor, $1 million for every social, $2 million on joint accounts. Plus, we're using the same sweep account technology to get them the highest possible rate every night. But not only are we providing a rate that today would be at about $350, we're benchmarking that rate every day and disclosing the rate. Like if I asked any of you, do you know what rate you're getting in your bank? Ask anybody walking down the street, hey, do you know what rate you're getting? They're going to say, 1% and 2%. The top 5 banks are between 0 and 2 basis points today. 0 and 2, not percent, basis points. So we actually launched in January, the first in U.S. history, SkyView U.S. National Average Checking Interest Index. Got through it for the first time.
Well done.
And what we're tracking is what's the average of the banks in this country actually paying depositors? Today it sits at 4 basis points. It's 4. So at 350, so we're disclosing the rate every day. This is what you're getting. Banks only have to do it once and you open the account. And second, we're benchmarking every day. Here's why you're getting, this is what most people are getting. That is unheard of in banking. They don't benchmark. Then fees, are they transparent with their fees? No, I just see fees all the time. I'm like, what is this? What do I do? So I think that that's where financial advisors could really act as a disruptor in the banking industry and displace that bank relationship. Because when you say bank relationship, banks have they haven't invested the money in the relationships. At the community bank level, they do, but the big banks are really controlling all the deposits. Does anyone have a relationship with the teller at the Wells Fargo window?
Not anymore.
That'd be odd, right?
This is
Awkward, I'd say.
fascinating, Scott, and it opens up the opportunity for dramatically improving the wealth management experience that an advisor offers their clients, and it goes into a more holistic financial advisory experience, right? So, as you said earlier, we render advice to investors on the investments that they have. But most advisors are begging their clients to come in with their bank statements, right, or to give them some sort of visibility into the loans they have and into the deposits they have at banks. Not just because they want held away assets and they want them to bring all that money under their roof, but they want to be able to render that more complete advisory experience because I can help you with that type of stuff. So this sounds like it opens the door for that in a new way.
Well, it really hit me over the head that we're working with, some great tech company entrepreneurs, and one just at a liquidity event. And he came to me and said, "Hey, I went into Morgan Stanley and I don't get it." I'm like, "What do you mean you don't get it?" So I don't get it. What do they do? And I'm like, "Well, they're your financial advisor. What are you talking about?" He goes, "Yeah, but I think all they do is like manage my investments. That's it." I'm like, "Well, what are you looking for?" "Yeah, that's it." He said, "Well, what about, my checking? What about my credit cards? What about my loans?" And that's really sort of clicked for me that financial advisors are only providing financial advice around investment portfolios. Yet they are the epicenter of, 90% of people's financial world. So for them to now extend that advice to banking products and services, to insurance products and services, the technology exists. The APIs are all out there. We just need to find somebody crazy enough to pull them all together.
Which is an important thing to do, because when you talk to an advisor or you talk to a banker, bankers think about the short-term balance sheet and the payments flow. Advisors think about the long-term balance sheet and how do we, grow the investment income that does it. That isn't how humans actually think about their world. In fact, they probably don't think about it as balance sheets. It's a holistic experience, right? This is something, John, you and I have debated, since the beginning of time that I've known you, is no one wakes up and says, "Boy, I really hope I can sit down with my advisor at Starbucks or in their office this quarter and let's talk about the difference between my alpha and my beta and standard deviations and stuff." They want to know, am I okay? Like, am I on track? Am I going to be able to retire? Can I afford, to have another kid? Right? Like, can I afford a new car? Like, what are the trade-offs? That's the question they're looking to go ask. And when we have this silos, and that's why I'm excited about what you're building, Scott, is you have the opportunity to give them the holistic kind of advice that they're actually looking for. And that advice is what will actually make them comfortable. Because today we are asking the client to be the point of integration. It's like, well, I can't tell you if you're okay because I don't know your whole life and all the things that are moving around. So let me tell you a bunch of data because that's what I feel comfortable, and slide some big old pieces of paper in front of you. And like you flip through and it still doesn't answer the question I'm looking for.
Well, and we're getting this question, like you said, to your retirement advice, like, am I okay for retirement? I know we've all probably had it recently, getting questions from my handyman, the guy who does my irrigation stuff, from people all over the country saying like, "Hey, this is the bank I'm with," and all of a sudden out of nowhere, like, come up with these names, like disclosing to me, like, "Hey, is this bank going to be okay?" Well, all of a sudden there appears to be a real need for banking advice. And we actually applied for trademark status on the term banking advice at the beginning of the year. Not in U.S. history, no one's applied for that term. Now, we probably won't get it because it's so vague, but we're going to keep working on it. But if you think about how I'm saying that, is because banks don't offer advice. They offer products and services, their own products and services. But financial advisors, if we build the correct ecosystem for them, can offer advice and saying, well, here's the 12 different banks you can get a mortgage from. This one appears to be the best. here's the 18 different auto loan providers. This seems to be the best. So really a truly comprehensive, holistic financial advisory experience that does include banking advice. And our MVP product is simple. It's just cash management. Not putting it at one bank, we're sweeping it to multiple banks, getting the best rate and heightened FDIC insurance. That's cash management banking advice.
But it's not just advice. That's the amazing thing to me. It's advice and services. It's take the actual service and wrap it with advice. So it's a complete offering. It's a complete experience. And I think that's what's amazing. Now, as you said, the wirehouses have been doing this for a while. But if you don't work for a wirehouse, and most of our audience left wirehouses, or if you don't work for a bank with a wealth management arm, right? This is a new thing to be able to offer, right? Banking as a service. Can you talk a little bit about that concept and sort of, where you see that going?
So I like to trademark stuff, I guess. I don't know. We also applied for financial advice as a service because we're offering a platform to offer truly comprehensive financial advice within a banking as a service component, as an example, mortgage as a service that'll be integrated as well. That really financial advisors in a completely customizable, scalable, white labeled solution so that the advisor owns this in every way to the client can really offer more than just banking as a service. But I mean, all these different service providers, it's just an API, it's just a different processor. They're plugging it all together. There's a lot of work to make sure they all cooperate and work together and have a user experience that fits, especially our demographic. That's historically has not been terribly fond of doing a lot of things digitally. But COVID did change that. And bringing it all together, the financial advisor can truly be a financial advisor. And if I think you're coming into, this tech entrepreneur, I think he's 33. And also he's got a ton of money, he never worked with an advisor. He thought financial advice meant financial advice. And sorry, that's not what it means. It means investment advice. So our goal is to strive towards providing that platform for an advisor to provide financial advice, comprehensive, not to mention the incremental monetization opportunity it holds for the advisor with every single different new product.
Well, it's both offense and defense. If you don't do it, somebody else will, and in all likelihood, they probably take over in the long term your advisory business. And as you said, Scott, it is also offense that it will allow you to not only get new sources of revenue, but also as you grow up better clients and stickier clients and help them better manage their holistic financial picture, they become better clients for you. It is a win-win. This is not about just aggregating more revenue from different streams.
You guys want to hear a scary fact, Jason? You're probably aware of this one, that after people set up their bill pay, banks retain that account. 60% of the time, they hold that account for the rest of their life.
Yep.
So we're building out a lot of technology and helping advisors get bill paid. Because we've all seen when financial advisors leave Wells Fargo or one of the banks, the attrition rate is dramatically higher. Why? Because I got my Netflix and everything set up at Wells. I don't want to change all that. It's a big hassle. Well, there's great technology out there that really facilitates changing direct deposit and bill pay, that we can get it done in a 15-minute phone call, get it all done. You just have to find the right tech providers, and they're out there. And what we're seeing today in the tech community is all this new tech is being spent and used and focused on the millennials. God bless them as we try to figure them all out day to day and what their consumer preferences are. But the baby boomers and the Gen Xers aren't seeing this great technology because everyone says, oh, the customer acquisition costs too high, forget about them. They're not going to change anyways. Well, if we're partnering with the financial advisor who's really directing their financial affairs, that's really a trusted source that, hey, maybe you should consider utilizing this, and look how easy it actually is to do.
That's fascinating. The thing is, I think there's a huge demand for this, for people to can you answer some basic questions about what's going on? Like, Jason, you're number one fintech podcast in the world. I think I heard earlier
in the world, top 1% of all podcasts.
So you're talking to startup founders a lot, and you've probably talked to, as I have, dozens of payment startups, dozens of financial wellness startups and so on and so forth. And so when the consumer sees this, they have no frame of reference. I mean, John and I were just talking about the SEC trying to have the due diligence process be on the advisor for evaluating some of the outsourced solutions they use, right? And John made the astute point of like most financial advisors aren't equipped to do due diligence on a software provider. They just don't know the questions asked and so forth. Well, most consumers have no idea how to evaluate a payments provider, how to figure out, is this a good bank account, bad bank?
I don't have any idea to do it either, Mike. I'm just hiring really
That's
smart
right.
people to tell me what to do. Thank God for them. I have no idea. I just got to
That's
try to
right.
keep them happy, right? I mean, I have no idea what's going really, and they're saying, well, this is the best because of this reason. But you're exactly right. And just that time it takes to go out and find all those solutions and sort of realize, I've got green light to give my daughter her allowance. I got Wells to do this. I got RBC to do that. I got a mortgage broker. I got a PNC broker. I don't want all these. I want one solution. I want to go to my financial advisor. He's my favorite person, right? It makes sense. I think for most people, that's the case.
And if wealth managers don't do this, the banks are really interested in doing this, aren't they, Jason?
The banks, many of which have very active wealth practices, they just historically have said, oh, we'll have an insurance business, and we'll have a wealth business, and we've got a bank, and they never integrate on them. Well, they're figuring out, wait a second, why do I treat Mike Langford as if he's three different people, depending on which silo I'm touching? And they're extracting up and saying, hey, this Mike Langford is three, of the same person doing three different sets of business, or maybe it's two and he should be part of the third. And they are bringing those things together now because they're recognizing there are a good number of fintech startups coming after that, really trying to make the holistic relationship. And banks and advisors have the opportunity. They have the customer and they have the data. They have the trust. They need to figure out, how do I layer on integrated products and services, or they're going to get wiped out.
Well, I think the other thing is, we see a lot of advertisements on CNBC from, Fisher and from Schwab about the importance of the fiduciary standard of care. I think what most consumers don't recognize is that their financial advisor may or may not be a fiduciary. And second, it is not a standard operating procedure in any other financial services industry or in insurance, right? So to the extent that they can work with their fiduciary financial advisor, extending that same fiduciary standard of care, not only their investments, but to your banking, your insurance, that they're actually acting in your client's best interest. I mean, it's so simple. I mean, if you're not doing that, you're not going to have clients for very long, right? But it's just not how it's done. I'm sorry, it's just not how banking is done. Banking is pay people as little as they can on their deposits and charge as much as they possibly can on the loan. And make the loan process so miserable that by the time you get to the end of it and they jack up your rate for some reason that they knew was already coming and they just use a teaser rate anyways, you're going to go with it and you're going to hate them. But they're going to lower what they pay you here, increase what they pay you over here. And that's banking. And that's not a fiduciary. I'm sorry, we got a lot of bank partners, but that's just the way it's done, and they don't have any choice. They have to manage a balance sheet.
But I think what I'm hearing from both you, Scott, and you, Jason, is that RIAs and wealth managers in general are in the pole position to deliver this kind of holistic advice, but they're not in the pole position forever, right? This is a lead and an opportunity that will go away over time as others realize that opportunity and go after it.
And you think about, though, the banks aren't in a position to really execute on this because they have a balance sheet, right, that they have to manage, and that does not really lend well to a fiduciary standard at the end of the day. I had to, Mike. And you're right, the fiduciary financial advisor is in the absolute best position to offer comprehensive financial advice because then you don't have to worry about it. When I go to my PNC broker, I mean, you tried to sleep with my ex-wife after we got divorced. I mean, do I really trust him? Yeah, but I'm too lazy to change. I don't care about that.
That's anyways, a metaphor, right, Scott?
I mean, I still use this guy. But then when he gives me a rate, I'm like, I don't trust him. But I don't want to go rate shopping, right? But if my financial advisor's doing it, they have to provide me the best options at the best rates. I don't have to worry about if I'm getting screwed over or not. That's peace of mind.
Well, it's interesting, too. You think about your banking relationship. Generally, it's somewhat product structured, right? It's around the product. Are you giving me the loan I need to buy the house, to buy the car, to buy the inventory for my business or whatever? That's the relationship. It's product related, right? Whereas when I'm talking to my financial advisor, it's goal related. Like, these are the things I want to accomplish in my life. Let's make sure we have an investment plan and an overall financial plan that get to me to where I want to go for my kids' college education, for my retirement, for my whatever, my estate needs or whatever. So I think it's a dramatically different relationship. And whether that advisor is sitting in his or her own office as an RIA or sitting in a bank's office, that's going to be really interesting to see how that plays out. Because I agree with you, John. They're really in pole position.
Well, it's a segue into another point. Like, if you look at the customer service experience between the average bank and the average financial advisor, we are worlds apart, right? Like, and I see that de-banking is basically they're shutting down branches. These branches are ghost towns. People aren't going in because they don't get good service. You have a 1-800 number. I don't care if you're Platinum, you're Advantage, you're Chase Private Client. You're calling an 800 number with problems, really. So now you think about it, if the financial advisor's office is almost seen as a quasi-bank branch by the client, they can handle almost any transaction except currency, which, by the way, we got a private ATM program as well. Technically, they could. They just can't accept cash. That's a much more palatable experience to go park in, a nice office building, talk to the financial advisor. They'll help you out. They know the staff. Mike comes and meets you at the door. John meets you. Deb's over here. That's a great experience, right? Instead of like going into a bank or calling an 800 number that you never get anywhere. And I don't care what your balance is and what level you're at. So it's also a premier service experience that's extended because the financial advisors are capturing very high ROI off that wealth management book. They don't need to capture that much more ROI off the banking products and services. They're already offering the service.
Wow. I'll tell you what an episode. From talking massive potential disaster to massive opportunity for wealth managers, I think we've sort of covered it all. Scott, if somebody's interested in teeing up this banking service, how do they get in touch with you?
They can visit SkyView.com and connect with our team there. We are doing a very piloted group of RIAs this year, but we're always interested in indications of interest until we get this thing launched here in May. So we'll have a more broader release probably in the third quarter, and we're looking forward to partnering with more advisors.
And Jason, if somebody wants more of that really smart goodness that you dropped on us, how do they get in touch?
Listen to us at Breaking Banks anywhere you listen to podcasts, or go to provoke.fm. You can check out our entire family. We are the HBO of financial service podcasting. And dropping this Thursday, same
trademarked
exact time with this one, is our recap at South by Southwest.
Love it. Well, this has been a fantastic episode, guys. Really appreciate you all on the show.
Thank you.
Thank you very much for listening to and/or watching this episode of the Augmented Advisor Podcast. It was fantastic to have you with us. I hope you enjoyed this conversation as much as we did. Huge thanks to Scott Wetzel from SkyView Partners and SkyView One, and Jason Henrichs from Alloy Labs and the Breaking Banks podcast for joining us. This type of conversation is what excites me so much about our industry. There's always new innovations popping up that allow financial advisors to serve clients better. Great stuff. Now, as I mentioned at the top of the show, please make sure you subscribe to the podcast on your favorite podcast platform, and swing on over to YouTube and click that subscribe button as well. And do us a favor, make sure you give the Blue Leaf page a follow on LinkedIn. We share every episode of this show on LinkedIn, and we would love to have you be a part of our community. Okay, that's it for today. Please make sure you're staying safe and be nice to each other. We'll see you next time on the Augmented Advisor Podcast. See ya. Bye.